I got two pieces of really important news. It looks like one, the institutional investors are now getting behind Alibaba and making it their top pick. And two, it looks like the regulators in China, at least the internet tech regulators, are saying that their regulatory activities are pretty much done. And so that's what we're going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. So really interesting pieces of news that came out today. The first thing is, institutional investors, Goldman Sachs and Morgan Stanley, are now getting behind the security and rating it their top pick in the sectors. And, I'm going to dive into a little bit more of sort of like what they're seeing and what they're saying. But the other important thing that I want to point out is that the internet regulator, this is something that I missed over the weekend. The internet regulator is now saying that, hey, we're pretty much done with the restructuring and regulations that we needed to get done. Now we want to promote a healthy growth of the internet tech business. And so I think just these two pieces of information combined, as they sort of permeate through the industry or the buy side, the institutional side, you're just going to get more money into the Chinese market. At least that's what I'm thinking. I don't really care if it happens or not. In fact, I hope that the share prices continue to go down because I'd like to buy more as there's been more cash coming into the portfolio. But hey, it is what it is. So just diving into the first part of this video, so you can see that Alibaba stock is now the top pick at Goldman Sachs and Morgan Stanley. Now, just 6 months ago, could you guys believe that the institutional investors, even like the sell side, because it always starts with the sell side, and then of course, the institutional investors, the buy side, will come in. But did you guys even think that it would be a top pick just 3 months ago? This is nuts. And effectively, it just becomes a vindication of all of us who've been holding stock for a year and a half now. If you guys are wondering why I'm talking a little bit softer right now, it's because I just have a newborn sleeping in the room next door. And so this is probably how I'm going to record videos late at night for just, maybe the next 6 months or so. Now, diving further into here, you can see that Alibaba received a boost on Monday after Goldman and Morgan elected the stock as their top picks. And so, Goldman said that Alibaba is one of the key beneficiaries amidst China's faster than expected reopening. I don't know how slow they expected the reopening to go. This just doesn't make sense to us. We were covering this for a long time. We knew that the reopening was going to happen when it did. It was just a matter of, were they going to do it safely, or were they just going to open the doors wide open? They ended up just opening the doors wide open, which was kind of nuts. And so there looks like a macro recovery from Q2 and normalizing internet regulations. And so as a result, the stock is added to Goldman's conviction list. The only thing that I would say is that although you have sort of like a macro recovery in your like views, I guess I would say, if we're entering into a global recession, could you see the slowdown in the West impacting China? I think you can. So I don't know about that macro picture perspective, but that's okay. Let's actually go into the article and see exactly what they're saying. So the first thing they say is they make the valuation argument, which is something we've been making on this channel for almost 2 years now. That's how long sort of like we've been hanging tight on this name. And so, we see Alibaba, this is Goldman, by the way, we see Alibaba at 11 times 2023's adjusted PE as the best value stock proxy to enjoy advertising recovery, fintech, via their 33% ownership of Ant. But I just want to point out that this might not end up being the final ownership of Ant. I know that it's probably like 95% chance that it'll just remain at 33%, but just, I'm just warning you guys that the CCP is unpredictable and they're not completed 100% yet. So this could change, but as it stands right now, we all think that it'll end up with 33% ownership in Ant. So that's fine. And the cloud structural growth. And I have some more words on this, which I'll speak to afterwards. I think there's just a little bit too much optimism in cloud as it relates to Alibaba and the stock overall, but we'll talk about that after. And so its top line growth resumes, and the 2022 to 2023 earnings resume to mid-teens growth. So they're expecting growth, like revenue, to resume into the mid-teens. So we'll look into that. Now, Morgan Stanley says that Alibaba's mispriced at 11 times 2024's PE. But my question is, where were these guys when the stock was trading at 60? I remember, or even like 80, I remember I was doubling down on the stock, and I walked you guys through exactly how I did the cash secured puts, which sort of like doubled down with a net purchase price of 70. And when it started coming back down again late last year, the thoughts in my mind were like, I really, really, really want to triple down. The problem is just portfolio diversification. I already had such a large exposure, more than I was comfortable with just one position. And so, I was really hoping that the stock would stay lower for longer. And I think it probably will in 2023 once people realize that the recovery is not going to be as quick and easy as, even the Goldman Sachs macro people predicted is. However, if it does recover, my question is, if Goldman was so positive on the economy, and they are, because you can actually look up their macro perspective, they actually just make it available online, then the question would be, why didn't they come out on this when the shares were like closer to $60 a share? I mean, like if you were to just add up just the cash on the balance sheet, you're looking at like $40 a share, if not more. And so, was the whole company worth $20 to $40 a share, even at $80? So is a whole company worth just $40 a share? It never made sense. Never, ever, ever. Normally, I don't double down in a big way on a security. I absolutely had to on Alibaba. I know a lot of you guys did too. Now, I never recommend you guys to double down or buy anything on the channel. I just provide my research, but it was just very interesting how we were all ahead of it. Now, just going back to this, Morgan Stanley believes an inflection in the cloud plus operating efficiency will drive an 18% adjusted EBITDA CAGR into 2026. And so, I think the same mistakes are being made where they're predicting just really high levels of growth. So, this could mean that they could flip-flop on this if Alibaba hits a road bump as it starts to get started, And so as a result, Alibaba stock is elevated to a non-consensus top pick at Morgan Stanley for the first time in 3 years. Okay, fine. Now, this is what I want to talk to you guys about. The analysts will talk about cloud, like the Morgan Stanley analysts did talk about cloud. But I just want you to pay attention. Notice here's the cloud. By the way, this is the model that the Patreons get access to. And so if you want access to this, you can just join us on the Patreon at the lower tier and you can get access to this model. I broke down all of the segments revenue in their individual sections because, when it comes to this kind of stuff, when analysts start talking about specific things, you can actually refer back to the model and see if what they're saying makes sense. And so in this situation, what the analysts are saying does not make sense. So here's what I mean. They're talking about, cloud being a large growth story for the company. And yes, it is. However, notice that's only 10% of their 2023 expected revenue. Okay. Total China commerce is still approximately 70% of the overall business. Also, you're not seeing it here, but cloud is not making a material adjusted EBITDA amount. In fact, it's pretty much break even right now. So although cloud will be growing fast, this is still a China commerce type business. And so I think Goldman has it more correct where they're focusing more on advertising, like ad revs for their core businesses. And you can, focus a little bit more on that because they're now really focused on growing out that grocery space and that team buying thing, like the community buying. And so, this is still a total China commerce story. And notice how the revenue, overall percentage of revenue for total China commerce doesn't necessarily change that much. It goes from 67 to 64. So 5 percentage points over the next 10 years. Now, this is just my opinion. This is just my forecast, but I just don't see how, total China commerce does not remain a substantial part of the business overall. But, the other thing about cloud is, yes, it does become close to 20% of the business in 2032, and that will drive a large fraction or amount of growth, and the adjusted EBITDA will pick up. But the area that we got to focus most on over the next 3 to 5 years is right here, the total China commerce. So I just want to point that out. And really what I'm trying to do is I'm just trying to taper your expectations from the cloud story. It's a sexy story. Amazon's doing it, Alphabet's doing it, Microsoft's doing it. It's very exciting, but I just want to sort of like put it into context because of how little it means to Alibaba right now. Yes, it'll mean something in the future. Growth in cloud has slowed for Alibaba and China as a whole. And so just be careful of this. That's all I'm trying to get across to you guys. And for those of you guys who are not familiar, Alibaba is once again still a China commerce business. So that's where Taobao, Tmall, and all, Taobao deals and Taobao Sai, these four businesses are where management is putting most of their focus, and this is what they talk about a lot. I also like Fresh Hippo, I like Sun Art, I like their wholesale business, but like this is the company. This is where all of the free cash flow is coming from right now. The rest of the company is a bet on future businesses' growth. What I really love is how well Lazada is now doing, and C Limited is starting to lose ground on Lazada. So I really love that. I love that Tencent divested their home delivery and Uber type app. I forgot the name of it. You guys can let me know in the comments. And so I think Le.me has a slight chance to accelerate and take some market share. I don't know if they will. Le.me has really been losing in that business, but we'll see how this plays out. I also like how their Cineao business is now working very closely with Taobao Deals and Taocaicai. And so these businesses working synergistically create an amazing ecosystem for success in both segments. And so I really love that. And then, of course, Alibaba Cloud is going international. And so, they're doing a lot of amazing things. But once again, we have to notice that, the vast majority all of the free cash flow is still coming from China commerce. So this is still a China play. And so what does that mean overall? Well, despite the recent share price surge, which I'll show you next, I still see this security as a grossly undervalued name. I'm valuing the company at around $230 per share, just using a terminal multiple of 15 times earnings and those revenue growth estimates that you just saw. And so I think it's trading at 50% of its intrinsic value. However, the thing that I do want to point out to you is that notice that I use a free cash flow per share valuation, and my free cash flow is net of the forecasted share-based compensation. And so I'm purposely reducing my free cash flow. And the reason why I'm doing that is because management issues a lot of shares to itself. And so that is a charge to the shareholders. And so you have to take that into account. So a lot of people will say that the company's trading at like 12 or 13 times free cash flow. Well, that's because they're not taking into account the stock-based compensation, which is directly money out of my pocket, right? If you issue management shares and then you report earnings on the quarter and you say, hey, we bought back, $7 billion of shares, but 20% of that is just to make up for the fact that you are buying back shares that you issued to management, then that 20% of the money is not really coming to me. That's just accounting gimmickry at the end of the day. Not necessarily accounting gimmickry, but you know what I mean. It's just something we have to take into account. So I believe the company is trading at approximately 21.5 times next year's earnings. So what this really is telling you is that the company is appropriately valued right now. And what's causing this share price valuation to be so high is the fact that it's still a high growing business or a fast growing business. So, when people say that it's cheap, it's not cheap necessarily on a valuation perspective unless you take into account growth. So just keep that in mind. And also, I could put this terminal multiple up to 20, and so you'll get a higher share price valuation. But what I'm really doing here is that over the next 10 years, I expect this multiple to contract by 6.5 turns down to 15 times earnings. And so that is actually negatively impacting the valuation here, and it's negatively impacting this $188 per share number. So just take that into account when you look at my valuation. And then also you guys let me know what the appropriate terminal multiple at the end of 10 years for Alibaba would be. Now this is what I mean. The analysts saw first the analysts saw this go down to $80 here. This is, I think, around where I doubled down. I don't exactly remember. I know it was in the springtime when I doubled down. You guys can let me know if you guys remember, but it's somewhere around here. And then I was kind of silent for the rest of the time. But notice that, everything started going down in November. And, I really I made a video where I was really considering tripling down. And the only thing that stopped me here was the fact that I was already overexposed to China. So I just want to overdo it, which is fine because you can always be wrong, right? You never know. I don't see a reason why I'd be wrong here, but, you always could be, right? And so I ended up buying other things. And so, we've now seen a 43% surge from the approximate 60% or $60 per share bottom. And so now Wall Street has woken up, and now Wall Street says that, it's gone up for 43%. It'll probably go up a little bit more. So, there's a story that Wall Street can pitch to the buy side. And I think it's a story that will be believed. People are looking for investments right now. People are probably underinvested internationally because a lot of people fled with their Chinese exposure. And so I think there's a lot of room for people to come back, and we probably will see the share price accelerate a little bit. I want to know what you guys think. Do you think that the share price will accelerate? Let me know. Now, the other important piece of news that I wanted to call out for you guys is that China's crackdown on tech giants is basically over, according to a top official. And so let's actually just see what they're saying. So it looks like this is actually coming directly from a regulator. And so they're saying that it's basically over, said Gu Xingqing. I apologize for butchering that name. And so the CCP's party boss at the People's Bank of China. And so basically they're saying next will promote healthy development of internet platforms, which is something that they had, they said about a year ago, and I covered it on this channel. And so they want to encourage the companies to come out strong in leading economic growth, creating more jobs and competing globally. And so it looks like the CCP is behind the Chinese tech names right now. Now, the only thing that I would say is, sometimes they're hot, sometimes they're cold. So, it's good that the CCP is behind the tech names right now, but let's just hope this lasts. That's all I'm trying to say. And, as Alibaba investors, we've seen the rough side of this, of course. And so that's it for the updates. I want to know from you guys, do you think Alibaba has legs to run some more right now? I think it does, but I think it takes some time. I don't think people rush into it. I don't think the institutional investors rush into it. I think everybody's being a little bit cautious in this environment, but can it be $150 by the end of the year? I think so. So I think it can run up another $40 per share. I'm just happy because my cash secured puts essentially are out of the money after it goes above $100 per share. In fact, I probably wish that they didn't go above $100 per share because I have a net $70 per share position. However, happy to keep that premium and reallocate it to something else. And so I'll leave it there for you guys. Now, if you recently missed my video where I analyzed Cathie Wood's portfolio and I completely analyzed one of those security positions, you can actually get access to that video right here.